you came out up front, you sent me a message in early 2023, and you said this is meant to be the year of fixed income, the year of bonds, and I don't think it is. And Oksana, over the last couple of weeks, based on what I've seen in the core fixed income part of the bond market, sovereign debt, the 2-year piece, you're right. What's going on?
So I think we're seeing essentially, you talked about the economy and whether what Powell is doing is sufficient to slow down the kind of economy we have today. And the kind of economy we have today is very different from the economy of the 70s or the early 80s, right, which was very goods and manufacturing oriented, or much more so than we are today. Today, 2/3 of our economy is services, and core services inflation continues to be strong. And that is what we were seeing coming into this year, along with a number of other indicators. But I think that's something we really can't lose sight of. The Fed has a direct knock-on effect on goods and manufacturing and housing, but how do you really have a direct knock-on effect on something like services, where you continue to see inflation, where you continue to see the most profound shortages in terms of employees for the job openings that are there? And so I think that will be a consistent issue. And of course, we're also seeing some goods-related inflation rise its head again, for example, in used cars, et cetera. But that's not to say that there won't be opportunities in bonds this year. We absolutely think that there will be. We are now, as a marketplace, operating at a vol level that has been, for many years, standard for bonds, right? If you look at the MOVE index, which is kind of the VIX's cousin in bond land, where it has been for the past 12 to 16 months, is where we used to live pre-Great Financial Crisis. That was kind of the normal volatility level for bonds. So perhaps with central banks removing their meddling, we're going back there, and that means great opportunities. But it is all about the price. Technicals really matter, and they will also drive fundamentals once they become dramatic enough. And fundamentals will have to adjust. And I can't say this often enough. Personal balance sheets, corporate balance sheets, government balance sheets, all of that has to adjust to the new reality of higher for longer. And that is where the opportunities will come once the marketplace and once the economy really internalizes that. And we're not there yet. We're in the latter innings of the hiking cycle, but we're not yet in the later innings of that acclimation process.
What I hear from you then is that high yield spreads have no business being at 390. Is that a fair assessment of your view?
Absolutely not.
So what are they doing down there?
390. Yeah, 390 is below long-term average. Forget, any recession average. And it has been, as I said, our view has been that the economy will be in the short term more resilient, and that's what we're continuing to see. And so, yes, balance sheets were generally strong coming into this, but no, high-yield spreads have no business being down there. And as you see more and more of these kinds of deals that are short-term, high coupon, right, just kind of a Hail Mary, last ditch attempt to try and stave off a refinancing. When you see deals that come to market and promise to pay you in kind as opposed to pay you back in money, these are all harbingers of wider spreads, down the road. So stay tuned. There will be great opportunities in credit.